Hey, hope everyone's having a good day. My name's Andy. My channel's Finding Value. I'm going to go over exit strategy. There's some comments saying, hey, look, can you go over the exit strategy? Maybe perhaps after we exit these things, which is 5 to 10 years from now. I want to know what the exit is and what the plan is. And perhaps some of the options after I exit my commodities, where should I go? So that's what this presentation is about. I'm going to pop in here and talk about exit strategy. So when commodities are topping, when the ratios get expensive, gold to whatever commodity ratio is going to be expensive. So the commodity will be expensive to gold. That ratio will be. The commodity to S&P 500 ratio will get expensive. The housing market's going to start to lose steam price-wise, and we're going to see the housing starts, which is new homes being built, will top out. That's the Fred housing starts. You can type that in to see the graph of that. So when the housing starts start to top and decline, this is what we're going to see. So we're going to see, I've got the commodity to S&P 500 ratio. Green is buy areas, red is sell areas. We're going to be way up in this 8 range. It's going to be in a sell area, and we should be waiting for it to peak and come a little bit back down, because that's probably when we're going to be heading out. And notice that all 3 of these had pretty big spikes. So we're looking for an 8 number roughly in that ratio. This is the gold to oil ratio, and I just want to show you that it gets expensive in relationship to gold. So green is when it's cheap, red is when it's expensive. I'm looking for a 10 where this red line is, where this to come down all the way below 10. Doesn't mean that right when it hits it we sell. It means that we are now looking to cost average out very slowly, or we're looking for the S&P on this one to get a red sell signal at around 8. If we're red here and we're at 8 here, I would say it's time to start cost averaging out. So here's the Fred housing starts. This is what I was talking about in housing starts. The green and red is overlaid. This right here is overlaid. This is overlaid on this, and this is overlaid on this one. So the housing starts, if you notice, will peak out and start to decline. That's a sell signal. Peak out and decline here. Sell signal if we have the red at 8 and the housing starts starting to decline. We've got green right now. It's going into an expansion phase. Everything is game on as of right now. So someone asked, what do you trade into? You get all these signals. What do you do with the cash afterwards? What's the strategy? So perhaps you go to cash or physical precious metals. Those are the 2 places you want to go. And the reason you want to go to cash is if you look at the housing starts, and when they decline, it always ends in a recession. So you've got a decline, recession, decline, recession, decline, recession, decline. We got this little recession there, a decline, recession, decline, recession. Notice how it's a decline, and then you've got these recessions. What that means is that the housing market is really what drives inflation into the system. That is your proof right there. And the deflation guys, when you're going and you're saying that we're going to have deflation and we are in an expansion phase of real estate, I just say, how the hell is that going to happen? You got to have your housing starts decline. I mean, they could shut down the economy. I mean, that's always possible. That's how they got this little recession going on right here, and how the housing starts dropped is because they stopped everything. And that makes sense. So the deflationists, you got to have a housing starts decline for that to happen. So what we have seen in the tops of commodities are these typically go 3 years past the top of the commodities boom. Physical precious metals do. So they go 3 years roughly past a red signal here. So this was 08, 3 years was 2011. This one was like 74, 3 years-ish is 77, 78. It peaked in 80 actually. So 3 to 5 to 6 years is roughly what that is past this commodity peak. This one here was in 90. That one was like a false breakout almost. So that's typically what it is. There's going to be a top in housing and a decline in housing starts. Also a decline in the house prices. This will be a deleveraging. It's a deleveraging. You leverage up when you take out loans on the housing start and expansion phase of real estate cycle. There's going to be a deleveraging or a contraction in foreclosures and whatnot on a backside of an oversupply recession in housing. So cash is a very good spot to be when that happened, because stocks precious metals, and housing will all crash. Housing will bring everything down. Commodity and S&P 500 flashes a sell signal for overvalued on the ratio, and the precious metals typically go 3 to 5 years longer than that signal. Stocks would be a great spot to be, as well as interest rates will be lowered during the recovery phase of real estate. So when you want to first go to cash, everything crashes down, then you want to go to stocks because you're not going to get that inflationary push when you're in a recovery phase of real estate. So in that recovery phase of real estate, you want to be hiding out in stocks because they're going to be lowering interest rates. They're going to be, the inflation's not going to be that big, and all of the input costs for those companies are going to go down. So it's going to be a risk on play. When interest rates are lowering, bonds go higher and stocks go higher under that environment. You don't want to go to bonds if interest rates are super low. You want to go to stocks because you'll get a better return than you would be going into bonds or something that doesn't yield anything when interest rates are low. That's what we do after a commodities boom. The commodities boom, my guess, will be 5 to 10 years in length, roughly in that ballpark. All of these will flash, sell, overvalued, and we move to cash. We wait for the crash in the housing market. If there is a big crash, maybe it's not that big. And then we go into stocks during a, quote, recovery phase of that cycle. It's that simple, guys. If you guys like this content, click the thumbs up button. Subscribe if you haven't. And again, you're listening to Finding Value. Thank you.